This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
All right, this is, I'm not sure whether it's the fourth or the fifth lecture on depreciation. But whatever, we've been through the ways of calculating depreciation, straight line reducing balance. And in the last lecture, I went through the double entry for accounting for the depreciation each year, just that one entry. But I did say that the remaining big thing we've got to deal with for the time being is what happens when that asset disappears. And to show you, look at example 4. Example 4. In example 3, now that's the one we did in the last lecture, which is still on the screen. I did say keep your figures, make sure we can look back. In example 3, we sell the car on 30th of September 2004 for 6,500. Now check where we're up to here. In the previous example, we bought it on the 1st of January 2002 and we had it for 3 years. So we depreciated 2002, second year took us to 2003, third year took us to June 2004. So that was after 3 years. They sold it in September 2004, so surely they're selling it in the 4th year. So we now need to look at, we've looked at 3 years, we need to look at the 4th year and see what happens. Now, to avoid it getting messy and getting confused, let me open up the accounts again. We did have a car account. And the balance on the car account was the original cost of 15,000. And we'd left that there, remember. We didn't touch the cost. We left the cost there all the time. We also, though, had an accumulated depreciation account. And at the end of the 3 years, we'd come to a total of 7,000. So we'd a balance of 7,000. And that was there to reduce the value of the car. On the statement of financial position, the car would appear at 15 minus 7, a net 8,000. We also had a depreciation expense account. We'd been recording each year the cost of depreciating, but each year the expense had gone to the statement of profit or loss, so we were left with a balance of 0. We start this year with a balance of 0. And so there was the position at 30th of June 2004. We're now going to deal with the last year, and in September they sell the car. Well, before we deal with the sale, there's one thing we'd better do. Now remember, our year end was June, so here's the position at June 2004. But we didn't sell it until September. And so we better depreciate for the rest of the life. You know, July, August, September, there's 3 months depreciation before we sell it. And so how much will the depreciation be? We'd already calculated it was it 2,800 a year? I think it was. But in the year in which we sold it, we'd only had it for July, August, September, 3 months. And so, before we sell it, we've got depreciation of 700. So let's depreciate, that's easy, we've had the entry enough. Credit the accumulated 700 to reduce the value, debit the expense. And although we've not come to the end of the year, just to hopefully make things obvious, the accumulated now, the balance has gone up to 7,700. And so although we're not going to do a statement of financial position, because we're not at the end of the year, we have got the car as being worth 15 less 77. The expense, well, of course, although we're not at the end of the year, that is the expense for this year, depreciating, because the car's about to disappear. And so don't forget, I'll send it to the statement of profit and loss. Get rid of it. However, now we've come to September. How are we going to deal with the sale? Well, watch me carefully. There are 3 entries we're going to make. First of all, the car is going to disappear. And so, obviously, if the car's disappearing, that 15,000 we no longer want. And so we remove that 15,000. We credit the car account with 15. And the balance is 0, the car's gone. The double entry, we create one new account called disposal account. We credit the car account, we debit the disposal account. And the car has now disappeared. Had there been lots of cars, the balance would be the total cost of all the cars. Remove the cost of the car that's been sold, and the balance left will be the cost of the cars that still remain. All right, the car's gone, but of course, what about the accumulated depreciation? Because the 2 accounts went together. The value of the car was cost less accumulated. But if there's no longer a car, we no longer want the accumulated depreciation either. We remove it. So the second entry, remove that 77, debit accumulated, and credit again disposal. And the accumulated disappeared, the balance is 0. Again, if there were lots of cars, the balance would have been the total of all the accumulated depreciation on all the cars. Remove the accumulated on the one that's been sold, and the balance left will be the accumulated on the ones that are still there. Anyway, here we've removed the car, removed accumulated. We've not finished yet, but just look at the balance on disposal. I'm not going to strike a balance yet because we haven't finished, but what does that represent? It's 15 debit, 77 credit. There's a net, what is it, 7,300. Surely that's the value we have on the car, cost less accumulated. However, the final entry is, of course, this car is sold. We sell it for how much? 6,500. What's the double entry going to be? When we sell it, debit cash 6,500, we'll receive cash. Credit the disposal account. The proceeds from the sale. So there are 3 entries. We've removed cost, we've removed accumulated, balance on depreciation expense is 0. But what about the disposal? There's a missing figure. The big side adds up to 15,000. The missing figure I'll have to check with my calculator, how embarrassing. I think that's right, actually. 15,000 minus 7,700 minus 6,500. Oh, it's only 800. Sorry. Well, what do you think that 800 is? Surely that 800, the value of the car, the book value, if we were doing a statement of financial position, would be cost less accumulated, which is 7,300. That's what we had it as being worth. And what did we sell it for? We sold it for 6,500. Well, the remaining 800, surely, you thought it was worth 7,300, we only got 6,500. That is the loss on sale. And what do you think is going to happen to it? The loss on sale. Well, to balance the account, credit disposal, that 800, we debit the statement of profit or loss with the loss on sale. Debit statement of profit or loss, just like we're debiting statement of profit or loss with the expense, the depreciation. It's an extra expense. And there we are. Now, several things before I leave this. First of all, the cash proceeds. I mean, the car may disappear for lots of reasons. Could be simply we sold it. Well, there we are. We sold for 6,500. It could be that the car we'd just thrown it away, destroyed. No problem. In which case the proceeds would be 0, and the missing figure, the loss on sale, would obviously be higher. It could be the car had been destroyed in an accident, but we had insurance. Well, fine. The cash proceeds would be whatever insurance money we received. If the insurance was 6,500, well, same again, loss 800. What else? Well, whatever happened, whether it was sold, insured, whatever, just suppose we'd received more cash. Suppose we'd received 7,500. Now, don't change yours, and I don't want to get messy. But if we'd received 7,500, well, you still remove the cost, you remove the accumulated, but the proceeds would be 7,500. And if the proceeds were 7,500, you have to imagine this, but this would now be the big side, 7,775, that would add up to 15,200. The missing figure would be 200 on the other side. And what would that be? Well, think about it. If you sold it for 7,500, it would be a profit on sale. And again, it would go to the statement of profit or loss, but with credit statement of profit or loss, it would be a profit. So no problem. I've shown you the entries. The missing figure could be on either side, but it's either a loss on sale and we debit statement of profit or loss, or it's a profit on sale. We end up crediting statement of profit or loss. One other thing though here, very, very common, is to see this statement. A statement saying our policy is to charge no depreciation in year of sale. Now, say that's very common in real life, and you might see that in exams. If you don't see that statement, then what we've done is absolutely perfect. But again, I don't want to make it messy, but just watch me and see what would happen if the same question, if that statement had been there, because it means exactly what it says. If their policy is to have no depreciation in the year of sale, then we don't. So what would happen? First of all, there wouldn't be that 700. If there's no depreciation in the year of sale, the fact we had it 3 months is irrelevant. We don't have that 700. And so there's no expense there in the statement of profit or loss. What happens when we come to dispose? Remove the cost, no problem. Remove the accumulated. But if we hadn't had that extra depreciation, the accumulated would only have been, where are we? 7,000, not 7,700. Bring in the proceeds, 6.5. But the missing figure now would have been 13,500, 1,500. Now, I hope I'm making sense here. Exactly the same entries. But if we hadn't had that 3 months depreciation, there's no depreciation expense, but the loss on sale would be 1,500. And it actually makes no difference at all. Because look at this. When we did it, in the statement of profit or loss, we'd have had expenses. We did have depreciation expense of 700, and we had a loss on sale of 800. If, on the other hand, there had been no depreciation in the year of sale, depreciation expense would have been 0, but the loss on sale would have been 1,500. And surely, and the reason this is such a common policy, is in total it makes no difference at all. Doesn't make any difference. It's 1,500 in total, whatever happens. And you see, the loss on sale isn't really a loss at all. You know, if you want to know the loss on sale, we paid 15,000 for this car and we only received 6,500. We've lost the difference. What it really is the fact, you see, if we'd have known from the very beginning that we'd be able to sell it for 6,500, we'd have depreciated differently. It would have gone down to 6.5, no profit, no loss. Well, of course, we don't know what we're going to get exactly. We estimated a scrap of 1,000 and we got 6.5. Well, all it is an adjustment. The loss on sale is just a bit extra depreciation because we haven't had enough, or if it's a profit, a bit less because we've had too much. And so it doesn't really make any difference. In exams, you do what you're told, clearly. But watch for that statement. If that statement isn't there, you do charge depreciation for those 3 months, and it's our original figures. If that statement is there, it doesn't change the rules at all, except you don't charge it for those 3 months. All right, a couple of final things before I leave this. One is, we've been doing what the question said, and in the exams you do what questions say. So, you know, when we did reducing balance, the question said it's 20% reducing balance. You use whatever percent you're told. But of course, why? In practice, why 20%? Why not 10% and so on? And when we did straight line, in the first example, the question said it was going to last 5 years with a scrap of 2,000. Where did those figures come from? In the exam, they give you them and you use them. But what do you do in real life? Well, in real life, there are no rules. The accounting standard says, do whatever you think is sensible. So there are no rules. If you think your cars will last about 5 years, use 5 years. If you think they'll last about 10 years, use 10 years. Exams will always tell you. But in real life, there is no rule. Some people tell me, there is in our country, we have to do it this way. But they're wrong. They're getting confused. For tax purposes, they may make you do it one way. But that's separate. In my accounts, I'll do it whatever way I think is sensible. If the tax people don't like it, we make some adjustments. But this is not a tax exam. So, I say again, there are no rules. You do what you think's reasonable. In the exam, you will be told what to do. That's one thing. The final thing is you will see there's a bit more to the chapter. Over the page, there's revaluation of non-current assets. There can come a time, whereas in most assets do fall in value, but if you've got a building, buildings very often increase in value. Well, you are allowed to increase the value subject to certain rules. We call it revaluing. But it's really only limited companies that would do that, and there are special rules. We've yet to talk about limited companies, so later when I talk about limited companies, I'll come back to that. It's easy enough, but I'll show you how we revalue. So for the moment, ignore that. Finally, there's mention of non-current asset register. That's really for you to read yourself. It doesn't need a lecture. But you see, if a business has lots and lots of cars, for instance, or machines, they'll have one T account for machines, showing the total cost of machines and the total accumulated. But they will need to keep records for each individual machine. So they will have a notebook which has nothing to do with the double entry. Most businesses will have a book where they're just keeping a record for each separate machine. And so have a read of paragraph 8 yourself. I think it's all perfectly clear. But no numbers involved. But in case there's mention of the non-current asset register, have a read and be clear what it is. Okay, otherwise that's the end of this adjustment depreciation. We'll leave that there.